Thanks everyone for coming on this gorgeous day in late November. It's a timely time to be taking a look at what's happening in the global oil market, given what's happening in geopolitics, the release of the World Energy Outlook last week, and also the release of the latest oil market report that Antoine's group is responsible for. So Antoine Halff is head of the Oil Industry and Markets Division at the International Energy Agency in Paris. Before that, he was a lead industry economist at the U.S. Energy Information Administration, and most importantly from our standpoint, was an adjunct professor here at CEPA. So we are really delighted that he was able to travel from Paris to be with us today and to tell us about where the global oil market is and where it's headed. He's going to speak for a while, and then we'll have a little bit of back and forth with questions and then open it up for questions from everyone else. So please join me in welcoming Antoine to Columbia.
Okay, thanks very much, Jason. Thanks very much for inviting me here today. I'm very happy to be here, very honored. And as you said, I was here teaching at CEPA for a few years. And I really enjoyed this experience. And I particularly value this setting because I find that CEPA is one of the few places where you can really think about the interaction, the interface between market issues, energy-related market issues, and energy geopolitics, or the politics of energy. And those two things really interact at a very deep level in many ways. But most of the time, people in the market, professional energy economists, analysts, can't really think these issues through very much. There's all kinds of constraints. And I guess at the IEA, we're very much aware of the interplay of those factors. But there are sensitivities about politics. So we have some constraints in the extent to which we can delve into these issues. But here at CEPA, this is the perfect setting to try to get down in the weeds and really think through how markets affect politics, how politics affect markets, especially in the energy sphere. And today, this is a particular significant, important juncture in energy markets because there are many developments here in the US as well as in the Middle East and North Africa, which have tremendous political potential or actual political implications, and which in turn affect the markets and affect the industry. So I thought we could have maybe a bit of a conversation about this. I have actually not one set, but two sets of slides, which I will perhaps go through very quickly. But since we're not such a large crowd, I think it might be possible for you to interrupt me if you have a pressing question, in the middle of a slide. Otherwise, I go quickly through the slides, and we can have maybe more of a questions and answers or conversations afterwards. So what I will not talk about very much, I hope I'm not disappointing anybody, but I will not talk very much about the World Energy Outlook because this is something that my colleague Fatih Birol will present in New York in a couple of weeks or in a week. And I want to leave it to him to really spell out the key messages from his publication that he's really orchestrated and in which my division has not had as direct a role as in the two other publications which I will discuss now. So the two publications I want to focus on are the medium-term oil market report, which we released about 5 months ago. And that's an annual publication that looks at 5 years. 5 years, why 5 years? Because it's the typical length of the market, the investment cycle. So the 5-year outlook is a time period for which we can predict with some degree of certainty or of confidence what we think will happen. Very different from the World Energy Outlook, which looks at 25, 30 years, and which is more a scenario type of exercise. And then I want to chat a little bit about the monthly oil market report, which is another animal, which is really a snapshot of current market conditions and a sort of effort to really measure and analyze current and very short-term supply, demand, inventories, price developments. So going through the key messages of our medium-term report, really there's a few things that I think stand out. We're looking in the next 5 years at a growth in production capacity, especially outside of OPEC, in what we call non-OPEC countries. Very significant growth, a growth of a scope that we haven't really seen in many years. But this growth, very significant, rapid growth, mostly in the US, in Canada, a little bit in Brazil, is happening against, and many people refer to it as a sort of revolution, but it's happening against the backdrop of another revolution, which is the so-called Arab Spring in the Middle East and North Africa, which also has very significant implications for energy supply, energy economics, and particularly in oil. So, you know, when the Arab Spring started unfolding in 2011 or late 2010, there were initial concerns about potential supply disruptions. Those concerns appear to be overstated initially because there was a brief disruption in Libyan exports during the civil war in that country, but then things came back almost to normal very, very quickly, much faster than people expected. But now we're starting to have the production effects of the Arab Spring. Things really are happening now, 2 years after the initial onset of this very large-scale process of political and social change that's really reshaping the region. So those are two very important revolutions, the North American supply revolution, the MENA revolution and its effects on oil. Now, in terms of demand, a key development has been the growth in demand from non-OECD countries, from the so-called emerging or recently industrialized economies, even as consumption in advanced economies in OECD countries is actually declining, continues to decline. There was a steep contraction after the financial crisis, 2008, 2009, but contraction continues and is forecast to go on for a few more years. So that's a significant development. That's not really anything new. That's more the continuation of a trend that's been in place for a period of a number of years, but it's continuing. But there's a third revolution which tends to be overlooked, that people don't really focus on very much. And that's the revolution that's affecting the way oil is distributed from the oil well to the consumers. The revolution in the supply chain, in the nature of the supply chain. And when we think about the developments in supply and demand, we tend to think about the reshaping of the map, the oil map. That's become a cliche, you know, in our analysis. The oil map is changing. We hear that all the time, and it's true. New supply coming on in the West, new demand coming on east of Suez, in Asia, in the Middle East. But it's not just horizontal. It's not just a reshaping of the map. It's also a vertical reshaping of the supply curve. And that's partly connected to the transformation of the refining industry. The refining industry is changing in a very significant way. Refining capacity is expanding much faster even than non-OPEC supply, certainly much faster than demand, and it's relocating in new countries, and it's moving from small, comparatively small refineries that used to be very close to their immediate market to very large refineries that are increasingly export-driven, export-geared, and that have a global reach. They no longer cater to their immediate surroundings, but they have the capacity and the interest. They're interested in shipping their products anywhere in the world where the arbitrage is calling for it. So those are very significant changes. So in terms of demand, as I mentioned, switch away from OECD to non-OECD. OECD demand is contracting slowly. Non-OECD demand is growing. We are expecting growth of about 7 million barrels per day over a period of 5 years, and that's entirely from non-OECD countries, mostly Asia, largely the Middle East. But what's different in the next 5 years from what we've seen in the last 10 years is that this non-OECD growth now is no longer occurring almost entirely from China. You know, from the last 10 years, China was 80%, 100% of non-OPEC, of non-OECD demand growth, really. That's where everything was happening. The pull of China on energy supplies was something that became a cliche in the media. India also saw some growth in demand. We see a slowdown in the pace of Chinese demand growth, and we see a bit of a transfer of demand growth away from the BRICS and towards the second, what we could call second-tier non-OECD countries, Southeast Asia, Africa in particular. African demand is undergoing a major takeoff. This is very poorly captured in the data because there's no African statistics to speak of. It's very poorly measured. But anecdotal evidence, evidence on the ground suggests that Africa is taking off. The economic growth as it is measured is probably underestimated in Africa, has outperformed economic growth anywhere else in the world since the financial crisis. Demand growth for oil is following suit. It's growing very fast. And we see trading companies build up import facilities all around Africa. So this is a very significant development. Now, in terms of what oil is used for, we see some changes there too. Traditionally, demand growth for oil has been driven by the transportation sector. That's still going to be the case. But for the first time, we see significant inroads of natural gas into the transportation sector in ways that for a long time seemed impossible. Right? For many, many years, we used to say, yes, one day in the future, natural gas will be used for automobile transportation, maybe for rail transportation. This seemed to be a very distant prospect. It didn't seem to be economical in the short or medium term. It's now happening. We see a potential for significant growth in gas demand for transport in the US in the next 5 years, as well as in China. In the US, it's driven by economics, by the low cost of natural gas, and the oversupply of gas looking for a market in this country. In China, it's driven mostly by environmental purposes. Beijing needs to clean up the air, especially around major urban centers like Beijing and others. And gas is a very good candidate to replace oil and clean up the air to some extent. So we see strong growth in this area. That's still something that's happening at the margin. But the margin in the oil market is, of course, very important, particularly in setting the price for oil and gas. So those are some of the key developments. In terms of supply, in our forecast in June, we were projecting that the US and Iraq would be the two major sources of new supply. It's becoming a little bit questionable whether Iraq will contribute as much as we thought it would back in June. We had our caveats at the time. We cautioned that there were many political issues that could slow things down in Iraq. It looks like things indeed are happening that are slowing down development in Iraq. There's many question marks. So we're not really sure. We're not really changing our forecast, but we're kind of putting more emphasis on the caveats and on the cautionary comments. But most of the growth for the next, we see significant growth there. We see more growth in production capacity than we see in demand. We see capacity growth of about 8.4 million barrels per day. That's significantly more than the growth that we expect in demand. And that results, by the way, let me go back to the first slide, that if I can, that results in a degree of spare capacity, spare OPEC capacity, that's higher on paper in the next 5 years than it's been in the last 15 years. Right? The dark blue columns there represent the projected capacity within OPEC that will not be used because the market will not need it. And that's a higher level of spare capacity than we have seen on a sustained basis at any time since the 1990s. Needless to say, back in the 1990s, the price of oil was not $100 as it is today. It was closer to $20 or lower. Does that mean that we're likely to go back to $20 oil? Most likely not. And what I would say is that this high spare capacity that we're projecting is not exactly the same animal as the spare capacity of the 1990s. Back in the 1990s, where the whole concept of spare capacity was formulated, spare capacity represented the capacity that OPEC countries, OPEC governments chose not to operate in order to support the market, to support prices. This was a discretionary measure by OPEC governments to support oil prices, and they kept, and this was mostly in Saudi Arabia, but not exclusively in Saudi Arabia. This was a decision by governments to withhold capacity in an effort to support prices and get more revenue per barrel. Spare capacity today is partly that, but only partly. Spare capacity includes anything from Iranian capacity that the Iranian government cannot use because of oil sanctions, to Nigerian capacity that the Nigerian National Petroleum Company cannot use because of protests and disruptions in the Niger Delta, attacks on pipelines, sabotage, what's called bunkering, pilfering from pipelines, all sorts of things. It might represent capacity in Venezuela that's temporarily out of commission for a number of reasons. It represents capacity in Libya that's currently off the market because of strikes, labor actions by different groups, asking for their piece of the rent, of the oil rent, asking for a seat at the table, some voice in how all decisions are made and formulated in Libya. So those volumes that are withheld from the market might not necessarily be volumes that the governments of oil-producing countries could put back on the market if they wanted to on a dime. So in many ways, it's more stranded capacity than spare capacity. And this reflects the transformation of the oil-producing countries' governments from governments led by authoritarian rulers to more democratic governments where the process of decision-making in the oil sector is becoming much more diffuse, much more fragmented, much more complicated. So it's a new reality. In terms of light title, you probably have spent quite a few hours here at CEPA discussing the North American supply revolution. And this is very significant. One small aspect maybe that I would draw your attention to, which perhaps is less commonly commented on than others, is the idea that in some ways the North American revolution, the light title, the shale oil, shale gas revolution, is supporting not only this new supply here in this country, but also is giving a new lease on life to many very conventional types of production in many parts of the world, ranging from Russia to the North Sea to Saudi Arabia. The technologies that have been developed, thanks to very high oil prices, to unlock the shale resource is also being applied to very conventional players, mature fields that were in decline and that can now be extended, whose life can be prolonged and whose production rates can be increased thanks to these new technologies. So this is creating a shift in investment away from frontier areas like new African countries where we found new reserves but which have not been actively developed so far. Investment is moving away from those regions to very mature regions which seem to be in decline, like the North Sea, like brownfields in Russia, and so on. So this is an unexpected, somewhat counterintuitive consequence of the shale revolution, which is to extend the life of the very conventional type of resource around the world. So if you here in this graph, the top graph kind of color codes where the new supply is coming from or has been coming from in the recent past and also in the next few years. And if you look at the historical period, that's the period when the graph is mostly red, and red here is the color code for FSU supply, Russian and the Caspian. And so back in the last 10 years or last 15 years, most of the non-OPEC supply growth came from that region. If we look now at the current period and the forecast period, it's all green. Green here is a color code for the American supply, for North America and South America, and that's where most of the new supply is expected to come from in the next few years. Number one, by a far margin, is the US, followed by Canada, by Brazil, by biofuels in our forecast, and so on. But it's very concentrated in just a few countries, and all in the Western Hemisphere. So this, of course, creates all kinds of challenges in terms of logistics, transportation, getting that supply to market, and so on. OPEC capacity we see as being very challenged, not so much by this new supply from North America, but challenged by the political developments within OPEC countries, in Libya, in Algeria, in Nigeria, as well as Iraq. So supply in these countries is the production capacity. We don't forecast production, but production capacity. We see growth there as slowed compared to what we would have expected before the Arab Spring. In Africa, we see zero growth in the next 5 years on balance. because we see major problems in Libya, major problems in Nigeria, very great reluctance of oil companies to invest in those countries, given security issues, political issues, so significant problems, significant slowdowns. Iraq has huge potential, is taking steps to unlock its potential, but is facing tremendous hurdles. Those hurdles, again, are political, security-related, red tape-related, corruption-related. So there's currently, this year, Iraq is far behind schedule in developing production. It's actually falling back. Whether it will deliver the growth that we expect in the next 5 years is not entirely certain, but the potential is there. And if the potential is tapped, Iraq would be a game changer. Let me skip this. In biofuels, we had a fairly robust forecast of about almost 500,000 barrels of growth. This could be scaled down, again, for political reasons. In the US, it looks like the government is responding to the reality of the blending wall, the limited capacity of the market to absorb more biofuel production, and slowing down, scaling down the production targets and the market targets. The same might happen in Europe. There's been some issues. Europe is kind of revisiting its biofuel targets, looking to cut back its goal of having 10% biofuel in the transport sector to maybe more like 5%. And there's also been some anti-dumping investigations against Argentina, for instance, for dumping, allegedly, potentially dumping biodiesel in Europe. So that could slow down things there as well. But one thing that we have focused a lot of work is the refining sector. And there we see growth of about almost 9 million barrels per day in just 5 years. So this is significantly more than the growth in crude production capacity or liquids production capacity, and even more than the growth in demand, which is much slower. So this is really a major transformation, and most of that growth here is forecast to come from China. China has been in the middle of a major expansion boom in the refining sector, and there's a lot more coming down the pipe. There might be some slowdown. Here we have a fairly conservative approach. We don't expect that all the projects that have been approved in China will come to fruition on time. Some may be delayed, some may be canceled. We generally assume that there would be less cancellation of projects than probably would be the case under similar market conditions in Western countries, because we think that in China, when something gets approved, it tends to stick. But maybe this assumption is overstated, because we've seen just in the last couple of months 2 major projects being postponed, one by Shell, another one. 2 major refineries have been expansion projects, and new build have been called off and put on hold. So we might see a little bit less, but even so, we see major growth in China, major growth in India, significant growth in the Middle East. That started this year with the startup of the Jubail refinery in Saudi Arabia, joint venture with Total, which is 400,000 barrels per day. There's another one, same size, due to come on stream next year, and a third one, same size again, somewhere around 2017. So this is really significant changes, and there's many other countries that are building, expanding refining capacity. This is really changing the way oil is processed and distributed and marketed around the world. It's creating a major challenge for some of the older refining sectors, the more mature refining sectors, particularly Europe. Europe's refining industry is in the midst of a major crisis. We've seen since 2008, 1.7 million barrels per day of capacity shut down. 15 refineries have closed down in Europe in the last few years since the financial crisis. Another one shut down just a couple of weeks ago, or was announced it's shut down very soon, just a couple of weeks ago. And we are forecasting that as many as 4 million barrels per day of capacity in Europe may be at risk in the next 5 years. Now, the WEO, and I'm not going to talk about the WEO too much, but the WEO is extending this forecast to 2035, and it's very much the same story. More capacity coming on from other parts of the world, and more closures likely in Europe and the more mature refining centers. Yes?
If it's okay to interrupt you.
Yeah.
On that last slide,
Uh-huh.
I assume that's net?
No, that's not net. That's gross. That's gross. That's why we're saying that there's capacity at risk, because this level of increase means that in order to keep refinery operating rates at historical levels, given the growth in consumption that we expect, we would have to shut down about 4 or 5 million barrels per day. Now, if we extend to 2035 and put in more growth in refining capacity, then according to the WIO, I think we go up to somewhere around 10 million barrels per day that needs to be shut down. In the North American market, we've seen a little bit less growth in refining, but we've seen some. There's been some growth last year. There's some growth expected this year, but much of the investment is not so much in crude distillation capacity than in the type of capacity, the upgrading capacity, and tinkering with the hardware to gear it more to the new type of supply in the market, the light tight oil, which is very different from the type of oil that most of the capacity in the Gulf Coast, for instance, in the last 20 years has been tailored to process. So the North American supply boom is an opportunity, is a great development, but it's also a challenge because it's not so easy for the refining industry to process it. It's great because it's cheap, it's discounted compared to international benchmarks. U.S. refiners have a great advantage in terms of very low cost, cheap supply, very cheap natural gas, which is the main source of energy for U.S. refineries. So they have a competitive advantage, but they also are challenged to process this new supply, which is of a different type, different quality than the traditional mainstay of the U.S. refinery diet. In terms of the way oil is traded, the fact that there's so much growth in the West, in the Americas, on the supply side, so much growth on the demand side east of Suez has major implications for how much oil is traded, how much crude is traded, and where it's traded to and from. And our expectations, and really it builds on recent developments, is that crude trade actually will decrease in volume in the next few years. Even though demand will grow and supply will grow, the volumes of crude traded over long distances internationally will diminish because more crude will be refined closer to the wellhead. In North America, the refineries are processing domestic crude, Canadian crude, as opposed to crude imported from West Africa, from the North Sea, from Latin America. So there's a change there. In the Middle East, refiners are processing more of their own crude, both to meet the domestic demand and also for export, to capture more of the value chain, to expand downstream. The only region which is importing more crude would be Asia, and the only region which, in our view, will increase its oil crude exports will be Africa. But the flip side of this development is that the international long-haul trade in refined products will increase significantly. And we see much more refined product exports from the Middle East. We've seen much more from North America. The US, for instance, until recently was the world's largest importer of products. It's now become the largest exporter of products in just a few years. And oil exports are now about to become the largest energy export in the US, and coal, oil, gas are about to become the leading source of export revenue for the US, as Citigroup recently showed in a recent study. So another development associated with the growth in refining, the changes in refining, is the changes in a sector that's very much ignored, typically in oil analysis, which is the storage and transportation sector, pipelines, terminals, tank farms, and so on. That's really undergoing major changes, and we haven't really begun to fully understand how this will affect the market, prices, oil security. One of the developments in the US, for instance, with the growth in new supply, has been the emergence of a very large group of transportation companies, typically master limited partnerships, which are independent. The transportation sector traditionally was a cost center integrated within vertically integrated companies or within refining companies. Just in the last few years, it's become an independent profit center. Small companies looking for profits, profit-oriented, and really trying to tap the opportunities and the needs created by the emergence of the light tight oil and shale gas in the US. This new sector, after exploding in recent years, has started to consolidate, and we've seen now a lot of mergers and acquisitions horizontally reshaping this sector, and the emergence of transportation majors, which is a new thing. These companies now are responsible for a large part of supplying products to the retail markets, and their behavior is bound to be quite different from the behavior of integrated companies in the past. They are, in effect, trading companies under another name, and they thrive on volatility. So, you know, and so this is happening in the US, but it's also happening worldwide to some degree. And as European refineries close down, Europe is also bound to become increasingly dependent on spot supplies provided by trading companies internationally. Now, this is a very different supply model from the one we've been accustomed to living with. In the past, refineries were the primary suppliers of product markets. A refiner's economic incentive is to run its plants as hard as possible to maximize the utilization of its assets. So the tendency in the market, the bias in the market there is oversupply. And that means that typically puts pressure on prices. That's good for consumers. A trading company is very different. It doesn't really have assets like refineries. Some do just to have a fit in the market, but typically it doesn't. And what it really thrives on is not maximizing the utilization of its assets, it's volatility. It's exploiting differences in prices between markets, between times of the year, and so on. So there the bias might prove to be more towards undersupply than oversupply, because an undersupplied market tends to be more volatile than an oversupplied market. So very different sets of incentives. So those are some of the big themes that we see for the medium-term market. Perhaps before we open it up for questions, I will now run through a quick snapshot of the market as we see it today. And the reason I do this in two sequences, not an integrated presentation, is also because many of you, I assume, not all of you, I guess, but many of you are students here at CIPA. So I would like this presentation to also give an insight into how we organize our work and how the work of the IEAs is being conducted and being structured, not just about the key messages. So, you know, we have this medium-term report, which I just went over in some great whose key messages I try to summarize. But we also do this short-term market, what we call the oil market report. It's a monthly publication. And this is a totally different exercise, completely different from the WEO. Right? The WEO, the World Energy Outlook, is a long-term forecast, which is peer-reviewed, extensively peer-reviewed. So to some degree, it's a kind of consensus view of the market for the next 25 years or 30 years. The medium-term report, the short-term report, the oil market report, is not peer-reviewed at all. It's kept under wraps until it's released. It's very confidential. It's market-sensitive. So it's a totally different animal, a very different exercise. So what do we see here? We take a quick look at prices, and the development in prices has been, there was big run-up in prices in the summertime as people were getting concerned about potential Western strikes on Syria. Since then, there's been a big decrease in prices, a big reversal, a very dramatic reversal in prices. Most people in the market, the mainstream media, New York Times and others, have said, yes, the Syrian crisis pushed prices up. But since then, there's been the agreement with Syria about destroying its chemical weapons. And there's been hopes that there might be a deal with Iran about the nuclear issue. And that's allowed prices to drop. In fact, that may be part of the story, but really it's only part of it. There's a lot more to this. And what we've seen is in the summertime, there was a massive increase in crude demand from the refining sector. Refinery runs worldwide reached levels that was completely unprecedented. There was a ramp up in refinery activity, unprecedented in steepness, something that had never happened before, and really resulted in a tightening of inventories of supply-demand conditions, which really pushed prices up. And Syria may be part of the story, but only part of it. Since then, we've seen the reverse. We've seen a drop in refining activity, almost as steep as the increase that preceded it, as refineries entered maintenance and as refining margins collapsed. And this created the opposite effect in terms of oil inventories. We've seen a big rebound in OECD oil in storage, and this naturally would tend to depress prices in a big way, which we think is what happened. Now, this period of maintenance is almost at, reaching its end, and seasonally, we are now on the verge of a new rebound in refinery activity, and that could support prices quite a bit. This context is this market context is really important in terms of how news developments about Syria or Iran or other sectors can translate into prices. A bullish headline in politics will have a bullish effect if the fundamentals are bullish, but might not be as bullish if the fundamentals are bearish. Right now, in the last couple of weeks, we had a very bearish market, and this allowed the bearish headlines about Iran to depress prices. But looking forward, we're going to have a very different type of market conditions. When we look at oil prices, not all oils are equal. As you know, there's different grades, different benchmarks, and they have different prices, and the relationship between those prices tend to change over time. So what we have observed in the first half of last year was a coming together of the key benchmarks, Brent in the North Sea, WTI here in the US. Since about early September, those benchmarks have fallen apart again, and we've seen a widening of the differential between the two. And basically, US crude prices have been trading at a deepening discount, widening discount to other international benchmarks. And that's partly because of new production, partly because of the seasonal decrease in runs in the US and logistical constraints, which are preventing US oil supply from being evacuated and traded internationally. In terms of demand, not too many big developments, but something that surprised the market has been the unexpected relative strength of European supply, European demand. There's been surprisingly strong demand from a number of European countries these last few months. That has caused some upward revisions of current demand estimates. Looking forward to next year, we do expect, generally speaking, a little bit of an increase in the pace of demand growth because we do expect the economy to continue to recover. But this is at a fairly subdued pace. So we now expect about 1 million barrels a day of new demand for 2013 and about 1.1 for next year. In terms of supply, big developments have been a major drop in OPEC supply, so collapse in Libyan supply and problems with Iraq. There's been many problems affecting Iraqi supply, which had grown last year, but now has been contracting again, has been slowing down. There's been some efforts to improve logistics in Basra, which is the main producing region in Iraq, but those efforts have been slowed down by all kinds of problems. There's been attacks in the north that have been slowing down exports from the Kurdish area and from the Kirkuk area. So less production there and less exports than expected. The call on OPEC, on the other hand, the amount of oil that the market needs from OPEC to balance demand has been pretty stable in terms of where it stands compared to forecast. So really, now the problems with Iraq and Libya until recently were partly offset by very high production from Saudi Arabia. Saudi has been producing very high rates, over 10 million barrels for 3 months, but just recently slowed down again and throttled back to under 10 million barrels per day. One key factor behind that, the seasonal slowdown in domestic demand in Saudi Arabia, but possibly also the lack of a market. Iran has been having a hard time placing its barrels under the sanctions regime, and even though there were some expectations that maybe sanctions would start leaking, unravel over the time, in fact, we found that the sanctions are becoming more effective, and that Iran, in the last couple of months, has faced many problems marketing its oil, and this has translated into a very steep increase in the amount of oil in floating storage, sitting around on tankers, looking for a market, unable to find buyers. So this is the context in which Iran has been engaging in international negotiations. It's really having a hard time selling its oil, and there's been no loosening of the sanctions in the last few months, quite the contrary. In terms of non-OPEC, one development that we've seen just lately, still very dramatic growth in North American supply, here color-coded red. But one development, last year, the growth in North American supply was offset by an unprecedented number of outages, of disruptions, and unforecast, unexpected disruptions all around the world, from the US to North Sea to the Sudan and South Sudan. So this year, those problems are getting solved, and we have seen a very significant rebound in non-OPEC supply from outside of North America. Even though in the next few years we see most of the growth coming from the Americas, recently we've seen quite a bit of a rebound from other parts of the non-OPEC region. We've seen growth from Russia, and this is both from brown fields where production declines have been arrested and also from green fields. And in terms of stocks, here it's quite interesting. For much of the year, OECD stocks have been about flat. And this is very much unlike the normal trend. Normally, OECD stocks build in the first 8 or 9 months of the year, prior to the onset of the peak winter demand season in the Northern Hemisphere. This year, even though we've had very comfortable supply growth and demand has been subdued, we've seen no such build-up, pre-winter build-up in inventories. Inventories have remained more or less flat until August. Very unusual, very counter-seasonal, and very difficult to explain because it contradicts our balances. It contradicts our estimates of supply and demand. What's the explanation behind this? Sometimes it can be that the supply-demand estimates are wrong. In this case, we don't think that's the reason. In this case, we think there's been a very dramatic increase in inventories outside of the OECD, where we don't measure inventories, where there's no process to capture in a comprehensive, timely, detailed, and verifiable fashion where inventories stand. But we think there's been a very dramatic buildup of stocks outside of the OECD, and partly in China, partly in response to new infrastructure developments, which tend to call for significant oil inventories in order to be operative. For instance, if you start a new pipeline, a new refinery, you have to put oil into that pipeline, into the tanks that service the refineries in order to run the pipeline and to operate the refinery. So we estimate that for the first 6 months of the year, maybe 1 million barrels per day on average may have been sunk into this new infrastructure and may have been absorbed by the market, sterilized in a way from the market. This is not really demand because it hasn't been consumed. This is not really storage because it's not available to the market. It cannot come out of storage, but it's been absorbed, it's been sterilized by the market in order to make these new facilities, this new infrastructure operable and to make it run. How long are we likely to see this type of demand or non-demand? That's difficult to say. But for the last couple of months, we've seen the reverse trend. We've seen a build-up in OECD stocks at the time of year where normally, with the onset of winter, we see a drawing down of inventories. So the inventory trend in OECD countries has been completely counter-seasonal from the beginning of the year to now, and in different ways. Now, in terms of refining, just a couple of months before I close these remarks, but the point here has been the very dramatic surge in refining activity in the summertime. Right? The black line in the top left graph here represents global refinery runs up to August. And in July, as you can see, they really surge above the historical range, the range of the last 5 years, by a very wide margin. And this really reflects new refining capacity in China, in India, and Saudi Arabia, but also the restart of capacity that had been taken down for maintenance. And really, I think that goes a long way towards explaining the run-up in prices that we experienced until early September. Since July, runs have started to decline, and after August, they fell very abruptly for maintenance, and also because the surge in runs cause refining margins to collapse. So we see the reverse. And in the OECD, it's very much a different pattern. Even though global refinery runs surge above their range, in the OECD they fell below their range recently. That's because the OECD demand is contracting, and also new non-OECD refining capacity is competing with the oil market. And that's especially true in Europe. European refinery activity is collapsing, and it's only a question of time. The question is not if capacity will shut down and if refineries will close permanently, but when they will do so and which ones will do so. Okay, so I think that's basically covers the main points I wanted to touch on, and I'd be more than happy to take questions.
Thanks so much. You're welcome to sit if you want. We have about 40 minutes for questions. Let me. I'll kick it off with a couple, and then we'll open it up for a conversation. So there's obviously one of the big questions that would affect the medium-term outlook and beyond, probably a little bit more beyond, is the extent to which the tight oil boom in North America can be replicated elsewhere. Right. Can you talk a little bit about how you and the IEA are thinking about that question?
Right. So when we think about the tight oil boom, I guess we have to think about a number of issues. One issue is the resource. What's the extent of the resource, and we have limited visibility on that. But there's been a lot of efforts to try to map the shale resource around the world in the last few years, and there are large resources out there, but the existence of the resource is not the only factor that can unlock it and make it available to the market. And there's other factors which include the quality of that resource, which include the existence or inexistence of infrastructure to support development, which includes the type of subsoil rights, the type of legislation, regulatory framework that might encourage or hinder development. So based on all those factors, we, in our medium-term report, we did not anticipate any large-scale replication of the North American success stories outside of the U.S. We think there will be efforts to develop resources in Argentina, in Russia, in China, but that in our estimates they were unlikely to bear fruit in a big way by our time horizon, which was 2018. Now, things could change, and there could be an acceleration of developments, but that was our best guess. Now, in the World Energy Outlook, I'm a little bit uncomfortable going over the WEO, because this is really something that I think Fatih will be much better placed to discuss and present early next month, I think, here in New York. But I think that the view is not completely different. It's not completely at odds with our view. And generally speaking, our medium-term report has served as an input, as a sort of initial input in WEO projections. The WEO extends to further out in the future, but there's no contradiction between our forecast and the WEO forecast. It's really consistent, and our detailed estimates for the next 5 years really serve as the foundation of the modeling exercise that the WEO team conducts. But I think the conclusions, I don't want to I would like to keep the powder dry for Fatih, but I think his view is that there will be some replication, but it's not going to be on a very large scale, pretty much for the reasons I mentioned, issues of regulatory framework, ownership issues, rights to the subsoil, challenges, technical challenges, availability of manpower, resources, and so on.
And the same question sort of for the United States, where there are various projections, particularly from some of the government agencies like EIA and IEA, that show U.S. tight oil production continuing to increase a couple of more years and then starting to decline. After that, there's a lot of heterogeneity in the forecasts that are out there, and some people see it continuing to grow. There seems to be a little bit of a trend where these forecasts for the time being are getting revised upward each year. That can't go on forever, but we had Adam Szymanski here a few weeks ago, and he indicated based on their new drilling productivity report, the next annual energy outlook would have higher numbers. Can you talk a little bit about how you see the U.S. tight oil outlook and how long increased growth can be sustained?
Yeah, so we see very strong growth, and we have been revising our forecasts ourselves, as did the EIA and others. So we now forecast for next year in terms of overall non-OPEC supply. Our forecast is now 1.8 million barrels per day, which is one of the highest in the industry. We're not the only ones to be so high, but we're very much at the high end of the range of forecasts. And this is essentially based on the strength of North American supply and light tight oil supply. We think it's going to be very strong for the next 5 years. But even within that time horizon, there are some caveats. And one caveat is, how will this oil be marketed? It's not that the resource is not there, it's not that the reserves are not there, or that the technical capacity to take it out is not there. The main challenge that we see for North American non-conventional supply, and especially U.S. light tight oil, is a marketing issue. And currently, under U.S. legislation, exports of crude are restricted. There's some exports to Canada. They've been increasing over the last few years, but from a very small base, and they represent just a very small fraction of domestic production. In our view, it will be difficult to continue developing light tight oil supply at the pace that we've seen in the last few years, unless there's some way is discovered to get around this legislation, either to change it, to amend it, or maybe to find ways in which it can be interpreted to allow crude exports. The way the market has worked until now is that the new domestic supply has backed out imports, for instance, imports from Nigeria and others, and has been refined, processed domestically, and exported in product form. Now, the reason why refined product exports in the U.S. have gone from not very much to the largest in the world is not only driven by light tight oil developments. That's one of a number of factors, but that's one very important factor, and that's allowed really the supply to find a market. But the capacity of the refining industry in the U.S. is not unlimited, and I think we will bump pretty soon against the downstream sector's capacity to handle a continued increase in domestic production. So the question is, will there be more refining capacity? Will more refining capacity be developed? That's not currently on the books. It doesn't sound very to make sense intuitively at a time when China, Saudi Arabia, and others are expanding their own refining capacity. That's not really a market in which you would want to really expand your downstream sector in a big way. So I think that will cause the question of what kind of a pressure valve will open to let production out of the U.S. and to continue to allow continued growth in domestic production.
So let's stay on crude exports for one more minute. I just want to ask you to spend another minute on that, because you sort of hear two different views on that. I thought I heard you say a limitation on crude exports can impact U.S. production and curtail how large the increases are. You sort of hear some people who say it's an issue and it's going to impose a cost, and refineries will have to figure out a way to adjust. And on the margin, that means a little bit less for producers, a little more for refiners. You see a price disconnect, but break-even costs are coming down, and you're still going to continue to produce, even if there's a small discount or something, or you have to install upgraders or topping units. On the other hand, you hear people say, no, it's much more severe than that. The costs are much larger. You're going to see larger price disconnects, and you really start to see U.S. tight oil production becoming uneconomic if you don't allow access to foreign markets. Did I hear you say you sort of agree with the latter of those?
Well, I think it may be a mix of the two, and not all light tight oil is equal. Some light tight oil plays are economical at low oil prices, others are not. The range of costs varies tremendously from one play to the next, and from one country or one sector to the next, sometimes within a very short geographical distance. So there's not a one-size-fits-all answer, but I think it's going to be a little bit of the latter. I think there's likely to be some cost pressures, and if those cost pressures are too high, that could slow down developments. And in fact, we've seen some slowdown, not so much in the US, but we've seen some in Canada. For instance, we've seen Total and Suncor cancel one of their upgraders because they couldn't market the syncrude that was expected to come out of the upgrader, because Canada used to market its syncrude. That's a very light sweet crude that's processed, derived through upgrading, through that complicated upgrading process from the oil sands production. It used to be marketed in the US, but because of the surge in light tight oil domestic production in the US, that syncrude is now finding it very difficult to find buyers in the US market, and is basically looking for new outlets. So this has caused the cancellation of this upgrading project, and this is an example of how market pressures can really affect the pace of development.
Let me ask one last question and then open it up. I wanted to ask you what all of this means for OPEC. We just had the 40th anniversary of the Arab oil embargo. There were lots of op-eds about how the shale boom is breaking the back of OPEC, and OPEC doesn't matter. There were others that said oil's priced in a global market. It doesn't really matter where you're getting your oil from. Can you talk a little bit about what the tight oil increase means for the Middle East and for OPEC countries? And in particular, you put up on the slide some pretty high numbers for OPEC spare capacity by the end of the decade. Does OPEC really sit on that amount of spare capacity, and how disciplined can they be, and what could that mean for oil prices?
Right. So I think it's not a simple question, and it doesn't call for a simple answer. There's been a lot of commentators saying the rise in U.S. domestic production is really the death knell of OPEC. It won't be able to survive. There's so much new supply that's going to displace OPEC oil. It's a lot more complicated than this. First of all, the new North American supply doesn't directly compete so far with OPEC oil, because it's not the North American market is not a market where OPEC has such a large market share, with the exception of Venezuela, and that Venezuela has been declining as a source of U.S. supply, and the new supply is light sweet, whereas most of the OPEC production tends to be medium or heavy sour. So there's no one-on-one competition at the moment between OPEC oil and new supply. Again, one exception, Nigeria, which had to shift its exports from the U.S. to increasingly to Asia. But on balance, it's not one-on-one competition. In a way, for OPEC, the internal challenges are much greater than the challenge that is represented by new North American supply. And for OPEC, I would say there's two key challenges. One challenge, or maybe three. One challenge would be the surge in Iraqi supply, which is possible if Iraq managed to develop its potential to really unlock its oil and increase its production rates to the extent that it wants and that it theoretically can. That would be a challenge for other suppliers in the Middle East. There would be direct one-on-one competition between them. Iran's return to the market could be a challenge for OPEC if sanctions were eased on Iran. But I think the key challenge for OPEC now is more internal and domestic in nature and political. It's been the effect of the Arab Spring and the political crisis and social crisis that ensued in the process of really the very dramatic, game-changing process of change that started in Tunisia and spread to Egypt, and or maybe we could say started in Iraq at the time of the Iraq War in 2003, and leading to the unseating of Saddam Hussein, and it's now spreading in the region. This is a long-term process of transformation, and the potential for chaos to spread. Currently, the eastern part of Libya is not producing anything because of social conflicts and political issues. The western part of Libya could be affected in the next few months. It's not impossible to imagine. And other countries, how the Syrian crisis evolves That's a risk for Syria. Is not a big producer; it's a small producer, and its production has fallen dramatically from about 600 or 400,000 barrels per day to about 50,000 barrels per day currently. But there's risks to the region if the civil conflict were allowed to spread even more than it has so far. So those issues are long-term issues, I think, that will stay with us for some time. They may not be easy to solve. And it's not just security, and the security concerns are very significant in Nigeria, in Libya, but it's also just the process of energy policy making. In Libya, for instance, we moved from a situation where policy making was a one-man process to a process where it's very fragmented, and companies willing to do business in the region, aside from security issues, are sometimes confused as to who they should be talking to. Who are the parties that really call the shots, and who is setting policy processes, and who's setting the terms, investment terms. This is not clear. And again, I don't think that's something that's going to be solved very quickly. It's going to be a long process, generational process of transformation, which could have long-ranging effects on the market. And that is why the dramatic surge in North American supply has not had a stronger price impact and market impact than it has so far. We've seen dramatic increase in U.S. production, North American production, and yet prices have remained at very elevated levels. Indeed, the Brent prices have averaged in the last 2 or 3 years at record levels, higher than the highs of 2008 at the peak of the run-up to the financial crisis. So it's a complex situation, but I don't think North American supply is really a threat to OPEC in the near term. And I think our view is that OPEC oil will be needed, will continue to be needed in the market, even when, as North American supply reaches its peaks, and then eventually North American supply will plateau and will set into decline, and at that point, OPEC oil will become even more important to balance demand and even more critical to meet market needs.
That's great. Thank you. So we have about 25 minutes for questions. There's a microphone over here. I think people will line up at it. Is that how we're doing it? Please identify yourself. Keep your questions brief. For those watching online, you can tweet your questions to us, and we will pose them on your behalf. And we'll start with Professor Bradford.
Hi, Antoine. Professor Bradford. I teach energy here now. It's really nice to have you back. I want to ask a question about the economic forecasts and risks underlying your market forecasts. I mean, obviously, every forecast like this has to have some assumptions about the economy. I'd love to hear more about what you think those general conditions are. And I'd like to hear more about the upside and downside risks, because I'm not sure which one I'm more concerned about, in that things go, prices go up because of good economic conditions. That sows the seeds of its own destruction. But equally, prices going down has implications on capital formation, investment, and additional capacity, as you mentioned. So I guess it seems like we are in a precarious relationship to the underlying economy because of all these macroeconomic variables. And precarious is never really good for creating the kind of investment conditions that would need to make your forecasts come true. So how do I square the circle on all of that?
Well, okay, so those are all good questions. So, we're a fairly small team. I mean, the IEA is about 250 people, but our team, my team is 10 people or less, sometimes a little bit more. It varies over time. So we can't forecast the entire economy, and we tend to take the IMF forecast as an input in our modeling, which doesn't necessarily mean that we have no concerns about the IMF forecast. And I don't think we have any specific concern today, but I remember I was in that same team 10 years ago in a different role looking at demand issues. And at that time, in 2001, the oil market was collapsing. And the IMF was maintaining a fairly robust economic forecast. And that seemed to be in contradiction with what we saw in the market. So at that point, we took the decision to discard the IMF forecast and to use completely different assumptions, which ended up being completely right. I mean, we were right to do so. But it was a very uncomfortable position to have, because we couldn't really we're not really economic forecasters, so it was very difficult to explain why we thought the IMF or the OECD forecast or other institutional forecasts made no sense, and why we took a different view. We couldn't really argue our view, defend our view in a very robust fashion, and at that point we thought that the best would not to disclose exactly our economic assumptions, to keep them fairly hazy. So not necessarily the best place to be. So today we are relying on IMF forecast. Whenever the IMF changes its forecast, we change our assumptions. We change the assumption that are used as an input, and our own forecast gets affected. But there are clearly risks to the forecast, and there's a great variety of risks. The biggest wild card is what China will do, Chinese forecasts tend to vary, especially in the oil market. There's each month, because of the volatility in Chinese data, as forecasters tend to extrapolate from current conditions, any monthly change in the data tends to result in changes in longer-term forecasts. So we try to stay away from too much month-to-month volatility. But there's clearly many questions about the Chinese economy. Our view is generally that the Chinese economy will slow down, will become more consumer-oriented, export-oriented, and we also estimate or assume that the Chinese government will support a policy that will shift some of the demand from oil towards natural gas, especially from coal to natural gas. But we see some shift from oil to gas in China in a way that's big enough to make a difference. Conversely, when it comes to Africa, there we feel that there's a lot of uncertainty as well, but we feel that the institutional forecasts underestimate the growth and the strength of the African economies in general, partly because it's very difficult. There's no robust data collection process in those countries, and a lot of the economy is not completely above board. There's a lot of gray market sector. But it looks like the African economy really is in takeoff mode. The development literature, the economic development community has not really, I think, caught up with changes on the ground, but things are really moving fast, and we see it anecdotally in oil. We see a lot of strength in oil demand in African countries, not just in oil, but also in electricity, in gas, in pretty much every type of energy. And we try to make some adjustments for that, but again, we can't really produce our own economic forecast for Africa, so we still rely on the IMF, but we use a little bit more of a stronger intensity factor energy intensity factor for African economies as they enter this takeoff period, which I think we can explain. I think a lot has to do with not only the strength of Chinese demand for commodities, but also the revolution of the cell phone. Africa has a higher cell phone penetration rate in the world, and this really, I think, is having an impact on the economy.
Great, thanks. I'd love to come back to that and talk more about what's going to happen in Africa and what some of the barriers might be. But next question, please.
Thank you so much. That was an excellent presentation. I have a question on Africa and a question on North America. With regard to Africa, Ghana and Israel were not present on your charts or in your discussion. With regard to Ghana, about 5 years ago, I guess it was, there was a big hullabaloo, supposedly a very large oil strike offshore, and then it suddenly dropped out of, there was U.S. investment, Chinese investment, State Department was all up in arms of the Chinese investment, and then it dropped out of sight and not on your chart. Can you explain what happened there? Will that ever be a factor in the future? With regard to Israel, that is real. Is that simply not within the 5-year time frame or not within the capacity? With regard to North America and the oil sands, the capacity in North America, I presume that's predominantly Canadian, if not exclusively Canadian. And are the IEAs predictions on the contribution of the oil sands without regard to how it's transported, the Keystone Pipeline or trains or whatever? And what relation, in one of your responses to Jason's question, you said there's not really a sufficient market for sweet crude from Canada. What relation does that have to the oil sands movement?
Right. So let me start with Ghana. Ghana is producing, and it's producing enough that month-to-month changes in production in Ghana can make a difference in the market. For instance, this month we had a big increase in non-OPEC supply. in October compared to September. And one of the factors was a restart in Ghana of production that had been off for maintenance. So it is on the map. It is on the map. But generally speaking, I think we see a little bit slower growth in new African producing countries than we expected. And that's partly a sort of somewhat counterintuitive consequence of the light tight oil development. There's just less appetite for investing in frontier areas when you can extract so much out of mature areas where you have infrastructure, we have a known political climate, a proven investment climate, and all kinds of support systems that enable that facilitate investment. So we see a little bit less growth in Africa in oil. Now, gas may be a different story, but in oil we see a little bit less growth in developments there than we would have. Consequence of unconventional developments. Israel, I think it's a gas story today. It's not really an oil story. I mean, there's talk of oil potential, but we're not there yet. For gas, it's a story, and that's something that my colleagues in the IEA gas division have been looking at, and the WEO has been, the World Energy Outlook has been looking at, and that's part of a larger story, which is the East Mediterranean gas story. And I think it's there. It's a big development, potentially, maybe not a global game changer, but a local game changer, and something that we're watching. We keep watching. There's a lot of political issues. There's a lot of uncertainties about political developments with regard to Israel-Turkish relations, Kurdistan, where does the Kurdistan fit in, Cyprus, and so on. But there's all the ingredients of a big story. And Syncrude and oil sands, Syncrude is, the light tight oil is one way oil sands can be brought to market. Basically, oil sands can be marketed either as bitumen, as heavy oil, or very processed as Syncrude. There's a little bit less market appetite for Syncrude because it's competing in the North American market with Bakken crude, for instance, which is, Bakken being pretty much where the Syncrude was marketed. So there's one-on-one direct competition between those crudes. But we do see growth in oil sands, significant growth in the next few years. And the Syncrude that's produced in Canada is not shut in. It's not completely locked. But it's fighting to find new markets, and those markets are largely domestic markets, west and east, and especially east on the Atlantic coast, Canadian Atlantic seaboard. Syncrude is being shipped by rail to refineries in Montreal, in New Brunswick, and there's plans to expand pipeline capacity or revert some existing pipeline to bring crude from Alberta to the maritime provinces. There's some projects to take it west. Some of the oil is making its way west. There's efforts to build pipelines west. There's environmental challenges to developing those pipelines. But clearly, regardless of what happens to Keystone, Canadian production will make its way to the U.S. market, whether it's Keystone or otherwise. It will get there. But also, partly because of all the problems with Keystone, there's strong political will, strong policy determination in Canada to not depend entirely on the U.S. market, but to find other markets for the Canadian crude. And we will see Canadian crude move to the East Coast and to the West Coast, and potentially it could be exported from there to the Asian market or even to the European market. You'll notice that in our map, we didn't put any arrows linking Canada to Asia or linking Canada to Europe. It's not that we don't think it's possible. We're not really sure how it's going to play out politically. There's many challenges to that. But also, we don't necessarily think it will happen on a large scale in the next 5 years. It might be more a story for beyond that.
Just to follow up before we go to the next question, but please come to the microphone. You talked about how the light tight oil boom is changing investment decisions. You also showed CapEx skyrocketing. What's the impact of that in the market, and how is that affecting investment decisions, and where are we seeing that impact companies?
Yeah, well, there's a lot of investment in capacity, and So some of it is in traditional conventional plays, and there's new investment directed at mature plays like the North Sea, which has been performing very well. Norwegian production fell at the slowest rate of decline of the last few years. So there's significant changes there. And we also see many companies around the world investing in non-conventional production in North America because it's a growth area, but also to acquire technology, to acquire know-how, and to be able to then transfer that technology and that know-how to new players.
Please.
Hi, my name is Bruce Robb. I'm a private investor. My question has to do with, you made a comment about technology, the enabling technology for some of these unconventional crudes being applied to conventional reserves. I guess my question is it technologies that have the ability to have any material impact on some conventional reserves? And could it bring some conventional reserves that have been tapped in for economic reasons, could it bring them back online and have some sort of impact on conventional volumes, either here in the United States or elsewhere globally?
Okay, so could shut-in production be restarted? I can't come up with any specific example, but certainly in the North Sea, especially the Norwegian sector, we're seeing an impact from more sophisticated technology being applied to existing fields. Same in brownfields in Russia. The decline rate in Russian brownfields has been revised downwards in our estimates, meaning a smaller decline than we expected, partly because of investment and partly because of the application of horizontal drilling, of some form of fractionation in existing mature wells. So this is having an impact. The Saudis have said that they were applying some non-conventional technologies in their mature fields. So we see impacts. I can't tell you exactly, orders of magnitude at the tip of my fingers, but we have made revisions to our previous estimates based on the application of those technologies in various fields.
Here in the United States?
So here in the United States, I'm not coming up with specific examples, but the next story in the United States is the Gulf of Mexico, conventional fields, offshore, deep offshore Gulf of Mexico, which had been partly delayed after the Macondo incident. There was a bit of a lag in investment, but we are expecting in the next few years a very significant growth in deepwater Gulf of Mexico production from the U.S. Now, potentially that could extend to Mexico if the Mexican reform efforts to reform the oil sector succeed. But in our expectations, in the next 5 years, we will see very significant development, very significant growth in U.S. Gulf of Mexico supply. And that's not going to be light tight oil or shale oil. It's going to be deep water.
Over here, and then Travis. Yeah.
Beth Evans, I'm a reporter with Platts. I had a question. You mentioned transportation majors and the rise of them here in the U.S. I was wondering who you consider to be the bigger transportation majors, and if they include the railroads at this point. And are you seeing a similar move in Europe and the Middle East and Asia?
Well, yeah. I mean, there was a flurry of MLPs that were created to develop new transportation options for backend crude and for other crudes, new production domestically. There's been a lot of horizontal consolidation of the sector in the last few years. So, companies like, there's any number of companies. I'm not really an expert on the corporate makeup of the sector, but I think it's a very important development that bears further examination. But looking at the East Coast specifically, for instance, companies like New Star, like Sonoco Logistics, all are increasing their footprint and are playing a large role. Buckeye, interestingly, linking the domestic transportation network in the U.S. between the Midwest and the East Coast, between the Midwest and the Gulf Coast, between the Gulf Coast and the East Coast, also with the Caribbeans. The Caribbean islands have always been an important storage and terminal sector, mostly in the past geared towards the residual fuel market, the bunker market, to some degree the crude market. And we're seeing an expansion of storage capacity in places like the Bahamas, in places like St. Lucia, but also a retooling of capacity to handle light products, not just resid, but distillate, light distillates, ultra-low sulfur diesel, gasoline. Tanking capacity in those markets is being expanded. Logistical links with the East Coast are being created to connect directly to facilities in New York Harbor in particular. And this is interesting but challenging because we can't really, there's not so much transparency about what's going on in the Caribbean, for instance. It's emerging as a major trading center, as a major terminal center where cargoes can be put together or can be broken up for shipping or for distribution. And that's likely going to be very important. Canadian crude might end up being stored in St. Lucia or the Bahamas for export then to Asia or elsewhere. But even as the Caribbean is becoming increasingly integrated with the US market, we do not have the type of data collection in the Caribbean that we have in the US. So it's a bit of a black box in terms of inventory levels, changes in stocks, and so on. And that creates all kinds of challenges for market participants and for policymakers.
I'm not sure if you noticed last week the U.S. rail industry requested that the government impose tougher safety standards on tank cars that carry crude. Do you think that is a necessary, needed step?
Well, yeah, I think it's expected as the sector becomes, as oil transport by rail becomes more and more important. I think it's expected that the safety standards for that become tightened and codified and more transparent. So that's it sounds to me like it's a step in the right direction, but also something that intuitively makes sense as you know, the volumes of oil transported by rail really become very large.
Please.
Yes. Antoine, when you were here last, we had talked about demand increasing by about 0.8% per year. And that was kind of the anticipated level. BP's there as well. Now you see some months here in your chart where we were above 2% for some of the quarters, right? And oil prices didn't collapse. Brent didn't collapse. It hung in there. Now you're calling for 1.8 million barrels of increased production in the coming year. The EIA is calling for about 1.9 million. So if we look at this, do we anticipate that oil prices will collapse, or do we anticipate that they will not collapse? And I'd add just a little addendum for you. In the last 3 weeks, product supplied in the United States is up 1.1 million barrels per day compared to the same period previous year. So it's up 6%. I'll leave my question there.
Okay. Well, the increase in non-OPEC supply is not an increase in global supply, right? There's OPEC and non-OPEC. So the increase in non-OPEC supply occurs against a backdrop of constraints on OPEC production growth. If you look back at 2008, there was basically zero non-OPEC supply growth, as I recall. But OPEC, when investment dried up or production growth dried up in non-OPEC, OPEC rose to the occasion. Saudi, in particular, increased production in a big way. So we're not seeing a big increase in OPEC production. Saudi has been producing at record levels in the last few months. Decreased a little bit last month, but was at record highs for 3 months running. But that's Saudi, and we've seen problems in Libya, we've seen problems in continued declines in Venezuela, problems in Nigeria, problems in Algeria, all kinds of problems. So the backdrop of this growth in non-OPEC supply is OPEC production problems and risks, you know, market perception of high risks to supply in a variety of countries. So that's that I think helps support prices to some degree. Demand. We're now looking at 1.1 million barrels per day for next year, probably for a period of years. That's kind of not the highest rate of growth, but certainly stronger than we've seen in the last couple of years. And you're right, in the US, we see a rebound. Now, we had seen in the US since about 2005 a decrease in domestic demand. Some of the decrease predated the financial crisis 2008-2009. After 2008-2009, the pace of decrease, of contraction increased. It's difficult to distinguish what are the cyclical factors linked to the market and what are the structural factors linked to improvements in efficiencies, to more efficient automobiles and so on, or to shifts in the nature of the economy and the offshoring of manufacturing and energy-intensive sectors. I think we're likely to see stronger demand growth in the U.S. than we had expected. The revolution in North America has sparked a little bit of an industrial revival in energy-intensive sectors. So a lot of that is designed to take advantage of cheap gas, but that could also support oil demand as well. So we might be surprised on the upside, but we're not. I think we could, as you know, the IEA doesn't forecast prices. We stay away from it as a matter of policy, but we have price assumptions in our forecast. In our medium-term forecast, we use the futures curve as a price assumption. In the WEO, it's a little bit more complicated. But I think the WEO is expecting a little bit of an increase in prices over time. Many people expect prices to ease in the next few years because of the surge in U.S. supply. I'm not sure we see so much of a decline. We might see a little bit of an easing of prices, but if prices drop too much, a lot of the non-OPEC supply might be affected. It's likely that in the U.S., light oil supply will be very price elastic because it's likely to be more responsive to prices than traditional production for a number of reasons. So we're seeing all kinds of reasons for saying that prices may not ease in a big way. We might not see a price collapse. But at the same time, the new production, the higher growth in supply than in demand that we anticipate, all that suggests that prices will not be subject to the type of upward pressures that we saw back in 2008.
We have about 60 seconds left for a quick question and response.
Yeah, this won't take much time at all, because I think the answer to the question is in how you framed the difference between spare capacity and stranded spare capacity, which I think is an absolutely amazing kind of distinction to draw within what is the normal number. So it would matter a great deal what the percentages of that spare capacity. You had about 6 to 7 million barrels per day of spare capacity. Looks pretty good even over the last couple of years, and yet we've still seen high prices. So where do you think we really are in terms of what percentage of that 6 to 7, or what volume of that 6 to 7 million barrels a day of spare capacity really is stranded, and how much of it is dispatchable?
Well, the problem is, how do you define stranded? We know traditionally the definition of spare capacity is capacity that can be brought on the market, not brought on the market, can be produced, brought to production within 30 days and sustained for 90 days. So within 30 days, that's so that it's not long-term capacity that would require investment and development work. It's there, and sustained for 90 days to distinguish it from surge capacity. So that's a fairly seemingly straightforward definition. How would you define stranded capacity? Is stranded capacity is stranded in Libya by labor action? Is that stranded for a week, for 2 weeks, for 6 months, for 6 years? It's very difficult to forecast. So that makes it difficult to me to distinguish between, to really draw a line between stranded and spare. I would say the most stringent definition of spare capacity would be Saudi capacity. Right. Saudi capacity. Right. Saudi capacity, I think now is spare capacity, is not stranded. So some people think Saudi capacity is the only spare capacity that the market can really count on. Well, that's about 2.5 million barrels per day.
But that's today.
That's today.
That's right. Not of the 7 in 2018.
That's today. That's expected to stay there because the Saudis are investing capacity, but they have a stated goal of keeping spare capacity within that range in their country, and I think they will adjust. I mean, the new capacity has come on stream recently. Initially, the plan was to mothball some oil capacity, to rest oil capacity and keep capacity pretty much flat. I think what we've seen is that the oil capacity has not really been rested yet. So we've seen a bit of an increase, but we see also growing demand, domestic demand within the country.
But just to be clear, we're over time, but just to be clear, when you say 7 million barrels a day in 2018, you're not saying 2.5 of Saudi and 4.5 million of global supply disruptions. You're looking at you're doing a call on OPEC analysis, which gets you to 7 million barrels.
Yeah, exactly.
Okay.
Exactly.
Great. I always learned an enormous amount talking to you, and hopefully everyone else did as well. The market is changing quickly, both for supply and demand and geopolitical and economic reasons. So I really appreciate your taking the time during your visit to New York to spend with us here at Columbia today. So please join me in thanking Antoine.